Hey guys, in this video we're going to be looking at AFDA journal entries. Hopefully you got to take a look at the last video where we were actually calculating bad debt expense, and here we'll actually take a deeper look at what those journal entries look like. So when we actually record bad debt expense under the allowance method, we debit our bad debt expense and then we credit this AFDA account, which is allowance for doubtful accounts. What it is it's just our estimate, our best estimate, given historical estimations of what we don't actually expect to receive from our accounts receivable. And only once we've identified specific accounts do we do this next journal entry, which is a write-off. So we debit AFDA to decrease our allowance account, and then we credit our accounts receivable to decrease our accounts receivable, because now we're able to identify, hey, this specific person isn't going to pay us back, so we feel comfortable actually writing down our accounts receivable. This next transaction actually is made up of two journal entries, and what we're going to talk about is what happens when someone whose account that we had previously written off with that debit to AFDA and credit to accounts receivable, when that person on that account comes back to us and says, hey, I'm actually able to now pay you. So what we do in that scenario is, of course, we'll want to debit our accounts receivable to increase that because now we expect to receive cash back from them, but we also want to credit our AFDA account. And what that does, it's increasing again that allowance for uncollectible accounts that we don't actually expect to receive. And so the reason we're crediting our AFDA account and increasing that account is because just because that specific customer decided to pay us back, that historical estimation of customers who aren't going to pay us back hasn't changed. And so if this person is now paying me, I'm still expecting someone else now to not pay me back. And so I want to increase my allowance account to take that into consideration moving forward into the future, so that when that customer comes forward and says, hey, I'm the one who's actually not going to pay you, I have that already recorded for in my AFDA account. And then the second journal entry for this is just debiting cash and then crediting your accounts receivable for when you actually receive that cash from the customer. Okay, great. So what I'm going to do now is just kind of highlight each of these transactions individually. So that top one is recording bad debt expense, the middle one is the write-off, and then that last one with the two journal entries is going to be when a customer is actually paying you back on an account that was previously written off. So the next step here is to say, okay, well, I know what these journal entries look like, but what impact does this actually have on my T accounts, right? I think T accounts are a really helpful way to visualize what's exactly going on and to kind of help keep track of everything. So on the left-hand side of the screen, I have your accounts receivable T account and your AFDA T account on the bottom. So remember, accounts receivable, that's an asset account, and your AFDA account is the contra account to that AR. So looking at this first journal entry here, when we debit for bad debt expense, that results in a credit in our AFDA account, right? So that bad debt expense will increase your AFDA account. And then when we're looking at our write-off, we have a debit to AFDA. So this debit side goes into the left side of our AFDA account, but it also decreases our accounts receivable as well with a credit. And last but not least is this last transaction here. There's not really a nice shorthand way to say it, but it's just when you're collecting payments from a previously written off account. And I also didn't leave myself a ton of room in my allowance for doubtful account T account, but I'm just going to go ahead and denote it with a star here to show that credit. And what this is doing is it's increasing your allowance account when you have received payment for a previously written off account. Finally, in my accounts receivable, I'm just going to show that increase and decrease in my accounts receivable for that cash collection on that payment. Net effect is 0, but it's just kind of helpful to show it increasing and decreasing with those two journal entries. The last thing I want to do in this video is to highlight what happens when we write off an account with this second journal entry here and the impact it has on our net accounts receivable. So we'll find that the net effect is 0, and I think the most helpful way to demonstrate that is with an example. So let's say here that our accounts receivable ending balance is 100, and then let's say the ending balance in our AFDA T account is 10. If we were to create the balance sheet right now, we would have, again, a balance in our AR account of 100, a balance in our AFDA account of 10, and since we know AFDA is a contra account to accounts receivable, that means that our net accounts receivable for the period would be 90. And moving forward, let's say that in the next period, we have identified a specific account that will be uncollectible, so we write off that account, we debit our AFDA account by 5, and we credit our accounts receivable by 5. This 5 is arbitrary and just the number I came up with for this example. So then looking at the T accounts for this new period where we had this write-off, again, our ending balance from the prior period will be the beginning balance in this next period, so we'll pull the 100 and the 10 down from those previous ending balances for our new beginning balances, and we have this write-off, right? So we debit our AFDA account by 5, and then we credit our accounts receivable by 5 as well. Our balance in our accounts receivable is 95, and our balance in our AFDA account is 5. And what this would look like on a balance sheet, again, is we would have a balance in that accounts receivable of 95, a balance in our AFDA account of 5, and since AFDA is a contra account to accounts receivable, that means our net accounts receivable is going to be 90. So the biggest takeaway here is that your net accounts receivable before and after a write-off will be exactly the same, right? There's going to be no net impact to your net accounts receivable. And just an additional takeaway, remember that your net accounts receivable is your net realizable value of your accounts receivable, and it's the amount you actually expect to receive from customers who paid on account. Last final note is that when you are making this journal entry for a write-off, note that there are no income statement accounts that are impacted here, and so a write-off has no impact on your overall net income. It's only that first journal entry we discussed where you're debiting bad debt expense and crediting AFDA that will impact your net income. So hopefully you found this helpful. Thanks for watching.